Traders, what's happening? Jamie Setley here. It is November 8th, 2018. And good morning to Jeha. How are you? Can you guys hear me? Can you see the screen? We will get started on these charts in front of FOMC later today. All right. So I want to take you back real quick to an update from Sunday. I think this is a pretty important chart given where we are right now. All right. This is the DXY and dollar Swedish krona, right? I think it's important to remember this. We do have this divergence in place where dollar SEK has failed to go through the high from August, and we did make one in DXY. So looking at that as a bearish indication for the dollar. Okay, now whether or not it plays out, it's a whole other story. But we do have that in place, that non-confirmation. So just remember that as we are going through some of these charts and as we get into FOMC later today. All right, so US dollar, really simple here. I am bearish and need to see resistance up here, I think at 12,215 in order to stay on a a path where we'd expect the dollar to accelerate lower, or where we'd be looking for the dollar to accelerate lower. Okay, if this does not hold, if we get back up through here, then it's back to kind of the sideways, grindy chop, upside chop at best, and maybe, a bigger run up towards the long-term median line. Which, look, I don't want to have to deal with that, I guess, but you have to have kind of the opposite, or not the exact opposite, but like whatever you think may or may not happen, you have to respect the potential for there to be an alternative view, and that would be the alternative view, right? We've talked about this level before, this 12,393, which is the next fib in US dollar, and we are seeing just a dramatic chop here. We have been, especially since August, the August high. We've got the pretty big divergence on the weekly with, get rid of this, with RSI. Okay, you've got a nice weekly reversal last week that we have followed through on the downside, broke the low. So you've got all the ingredients there for this to be, in more of an important peak, okay? But near term, timing wise, I mean, we still haven't broken a low. We need to break this low, this October 16th low. If we can break that low, then maybe finally we can say that we've got something going on the downside. That's the story with US dollar. All right, euro. Let's remember this long-term chart as we head into FOMC. You've got the writing along this long-term parallel. You've got the lows, kind of, or the highs here, but the lows of this year in August and last week, not quite there, right on the 200-week average. But this is, to me, a large neckline that we bottomed on in August to the tick, and looking for us to resume higher out of this, right? Now, we've talked about how I believe that this is an A and a B, right? 3 waves up, 3 waves down. Does set up very well for us to have an impulsive rally in euro. So it would be something like this, right? 5 waves up, and then you'd fail. I don't want to look too far out into the future. about as far out into the future as I'm willing to look right now is, you know, after today, or, you know, the next couple of hours, because we need to see the euro, you know, kind of get up out of here in order for this interpretation to be, you know, somewhat valid. And we're dealing with this short-term chart over here, right? So looking for that low right on really the weekly opening price. I mean, right on it. I left the order in overnight just in case, and I'll leave it in front of FOMC. It's just a really good spot. And if the euro's going to bottom, that's where it's going to bottom. You know, otherwise just completely wrong and we're headed lower and the risk is pretty good, right? Stop under here. But if we are going to head higher, in my opinion, we are heading higher from this region right here, 1387. Maybe you get 1378, but who's, you know, counting, you know, 10 pips between friends, as Mike would say. But yeah, we're looking right here and then looking for us to come up out of here. The first big test would be up probably around 1620, which is, of course, the high from August 16th. So we'll see and let that simmer, let that play out and see if, you know, it wants to work for us or not. But I like the trade. I like the idea. That said, there are places where I think, you know, we could have the opportunity to actually be on the other side of the dollar. And this is where, you know, you have to have in this period of real uncertainty, like where, you know, a strong or weak dollar view generally, like I think we're topping in the dollar, right? I've made no bones about that. But the question is, have we topped? And we have had some big runs here recently in a number of currencies, not the euro per se, but pound, Aussie, Kiwi, right? Euro and CAD and yen have kind of been the weak ones. You know, so we could see some bigger reactions, and we are getting a nice reaction off of this median line in cable. What I really like about this is that now we have a structure that we could be dealing with for some time. You know, let's go out and show you just some of the pitchforks in cable that have worked for such long extended periods of time. So let's go to a daily. This will be a good little study to look at. Okay, so you can see this pattern in cable. So like, you know, the up, kind of down, retest the lows, right? It's almost the opposite of this one, right? Down, up, retest the highs. It's almost the exact opposite. In fact, what is that? Interesting to see what an analog would look like there. 3 months, 8, just about 3 months. All right, so here was one back here, okay, kind of similar. You had about 3.5 months apart on the test, okay? And then if you were to draw your fork in here, look how great that worked out and for how long it worked out, right? It's a lot like the Japanese yen has been trading in its you know, has been trading in its fork since February. So, you know, we could have something to work with like this. And I love how this is what I'm getting at, where you see how it's confirmed. Because look at what when we traded up to the median line right here is confirmed. That's a lot like what's happening right here, okay? So we draw that in. All right, and you can see where we are here within the fork. So the first place you're looking kind of, again, I've got the basically 130 in line for support. The 25 line at this point would be a little lower, but again, the parallel I've got is off of this low here. So bottom line is 130 is a spot. If you do sneak a little bit lower, you know, we could be looking at more of a retracement level. down towards 29.60, 70s, which is 11.5 low. Either way, we have a very solid game plan with these levels heading into, you know, FOMC and beyond. And frankly, FOMC doesn't even matter. The chart's the chart. The chart doesn't know that FOMC is there or not, right? So as I mentioned last night in the piece, I'd kind of be willing to do two things here. One, fade a spike up to 132, okay? And two, buy the dip with the first level at this point being around that 130 mark, right? 129.99 is the high volume close from the other day. And I can show you that right here too on the daily chart of British pounds. Okay, so you can see that big volume spike right there? When you get these volume spikes, the close of those days or hour, right? We talked about the hour one last night as well in Kiwi, but they tend to, you know, provide pretty good reference points. And, you know, just look back to 9.5, very similar, right? That high volume level was actually support for 3 days. You went higher, and then you came back and tested it, and it was support again in early October. You know, here's some good examples of high volume levels. High volume level support, high volume level resistance. Okay, so that's an important objective level to look at. I really love the high volume levels as using them as support resistance because, you know, they're completely objective. I mean, it's not like we drew a fib and we had to decide where to draw the fib from, or we drew a trend line or a slope line and we had to, you know, they are what they are. They happen. They're right there. It was the biggest volume in X amount of days or X amount of weeks or hours or whatever. And, you know, it's there. There's no arguing it. It happened. So it's a big level. That 130 level in cable, awfully important. All right. So those are the two things we're looking at here on the British pound. Okay. Australian dollar. Four-hour chart. First of all, we have broken above this line, which is important. Trading just above it. Remains to be seen if this is a so-called false break or not. Wave count wise, actually really clean here. You've got 1, 2, 1, 2, 3, 4. What looks like 5. We may have just eked out a little fifth wave high on this push higher right here, right? So from a wave count perspective, to me, this says, you know, kind of respect fourth wave potential here. You know, if we got 1, 2, and then 3, be looking for a drop in 4. And your best spot for the drop in 4 to find support, probably in the 71.82 to 71.98 region. Again, 71. Habib says, yeah, okay, Habib, I will answer your question, absolutely, and thanks for joining us. And watch this, you'll be watching this later, but yeah, I will look at the daily and weeklies for you on the S&P. So yes, with Aussie, game plan here is to kind of, you know, allow FOMC to happen, but looking for maybe a fourth wave drop, and in which case you could get, you know, 100 pip drop from here. And then we'd be looking for support in a fourth somewhere around, again, that 71.82, which is the you know, former fourth wave low right here. And then this is a high volume level, 71.98, call it 72. So we'll see what FOMC does. You know, you may get a spike or something, you may get a little volume action, and then we can work from there with a short-term reference point, and maybe actually even have a short opportunity for a quick one, you know, that lasts maybe a day in Aussie. But we want to let FOMC pass. There's no need to gamble in front of that at this point, especially when we're trading what I think is against the broader trend with Aussie. Which would be kind of looking for a little bit more of a pullback. And let's not forget too, so we have FOMC, but you know what else is coming up? You got RBA, right? So that's tonight. So, you know, you could certainly have a scenario in which Aussie maybe surprises and goes the other direction, even if FOMC sends the dollar, you know, lower and Aussie a little higher again. All right. Now, if we work our way out a little bit more, we do want to realize that we have come into a fairly important spot for the Australian dollar. You are coming into this, you see this low right here, okay, that's 73.29. And, you know, we currently traded to 73.02 this morning. So, you know, a wee bit higher and you'd be on not just that low, which is from May of 2017, but you've got this whole series of lows from June through August, okay? And then the high up here, which we just took out, or no, we didn't take it out, very close, 73.14 in September. So there is a lot of stuff there. You know, I do think that Aussie has tried to put in a very important low down here. Remember the long-term, we go to that long-term chart, go to the long-term page, and you can see that. Might as well pull it up live for you here anyway, but there it is. So remember the long-term page, we have bottomed on a big spot, okay? But is it going to be a straight shot to the upside? Usually it's not, right? So this huge level here is something to contend with, and something where, you know, a drop back into the mentioned, you know, 72 area would not be at all a surprise from here, even with the understanding or belief that that Aussie's turned the corner for a bigger move to the upside, okay? So that's where my head's at with the Australian dollar. Moving on, let's take a look at Kiwi. I want to get through this currency stuff real quick because I do actually have a lot I want to look at, and you know, kind of watching the time here. I do have a lot I want to look at with S&P, NASDAQ, and China as well. Maybe the most important thing to follow. Okay, so Kiwi levels are a thing of beauty right now. Again, the longer term chart, for context, we don't want to forget. Remember, I did update those longer term charts a couple of weeks ago, and you know, tried to do them at a timely, because I was thinking that we would have this opportunity, the dollar would be turning. So, you know, I did it at an important point. That was the reason for doing them, but we have turned up, right, in Kiwi, and you know, frankly, we're higher. Like Aussie, we are into some pretty important spots, okay? This weekly chart right here, you can see, right? Lows back in December 2016, May of 2017, right? October last year, November last year, all this consolidation over the summer in July. So, you know, don't be surprised if we have a little bit of a back and fill, you know, pullback action right here in Kiwi, but I do think eventually resolves higher. All right. And if we go to that short-term chart for Kiwi, really beautiful here. What we're looking at, I think, is an ideal buy the dip scenario down towards these highs here and the fork here. And again, that's going to be 67 to 67.30. All right. And, you know, where would I be willing to maybe fade this move on the upside? Doing it right here, right in front of FOMC, you know how much I don't like to do that, especially believing with the larger turns at hand. But, you know, 68, 60, 68, 70 would be a spot. Now you're wondering, where the hell is this line, this random line come off of? Remember, this is the channel width, right? So this was the channel that we're following, okay? And just because the channel's broken, a lot of people, after the channel breaks, they get rid of it. Well, I'm sure you guys have seen enough over, you know, however long you've been here to know that it's not, even though the channel breaks, it's still useful. Okay. In fact, what happens is a lot of times you travel the width of the channel break. In this case, you take the width and you extend it off. And that gets you up here, which intersects with the upper fork, which is great. And you got such that, the really big levels up here. So, May low, right? July high, 2 highs in July. And yes, 2 highs in July. And that's going to be 68.60, 68.70. Okay. So those are your 2 levels that I would, paying attention to, focusing on with the New Zealand dollar in not just today, but probably the next couple of days, right? 68.70 and let's call it 67 to 67.30. So nice, solid levels to work with right there. All right, dollar CAD. 1, 2, 3, 4. Last night I think we were in 5 up and we were about completing 5 as I was writing this, and sure enough, 1, 2, 3, 4, 5 pullback. Can envision the Canadian dollar going higher from here, or sorry, not the Canadian dollar, but the dollar CAD. So this is one that's completely contrary to a broader, bearish bias in the dollar. Again, not a big fan of just leaving orders right in front of FOMC going counter, but as we get closer here, the next couple of hours, I might just say, I'll send out a tweet if I'm putting an order in for dollar CAD, but understand that we have hit the level overnight that we were thinking. And the dollar CAD, to me, this looks like it just wants to kind of, you want to try to take it higher, 32.50, 32.60. Okay, and this is, again, this is the channel width thing. So this is the channel in dollar CAD. This is half channel width. So half channel width intersects this level up here. If we go full channel width, going to get all the way up here, basically on the highs, somewhere out late this month. Okay. So okay to be bullish dollar CAD here, despite the fact that it's completely against the supposed dollar bearish bias, but whatever. Marco says, I know you don't like crosses, but I have to conclude that you're generally bullish Aussie CAD, right? Yeah, I guess we could go that way. I guess my thing with crosses, and look, sometimes I do trade them, right? It's rare, but sometimes I do. Here's my thing with it. It's like, you have to be, I think, really right. Like I could be wrong on a dollar bearish bias, but if I have some, a dollar bull trade here, dollar bear trade there, especially heading into something like FOMC, then I have a better chance of making money and not losing money. Like with Kiwi CAD or Aussie CAD, you have to be right kind of on both of them, I feel like, to get it, so it works for you. I mean, let's see what like Kiwi CAD looks like, for example. All right. Funny enough, we're right at the month open. Yeah, I mean, I just don't even want to. It's ugly as sin. I don't want to look at that thing. Ugh. Get rid of that. All right. We'll get back to this. So that's the dollar CAD story. Look, I'll go to a daily chart real quick. If we do break down, you're looking back at 130, call it 130.13. You can see that we've been trading between these fibs. You can see the fibs here. I'll get rid of everything so that you can just see the fibs. Right? Probably even the 23.6. Yeah. So this is 23.6, 38.2, 618, 786. So we've been trading more or less between these levels. looking at this right now, dollar CAD looks higher. You get a quick drop, and then you're going to see support here around 30.15, 130, 130.15. So we'll leave it at that. But the levels heading into FOMC. All right. Dollar yen. I know DSI on yen right now is like 17, so it's pretty low. If we're going to get to single digits, we might need yet another push in this. You can see on the election, I tweeted it out at the time, but the election, we had came down to the month open, to the tick. Low on here on this platform, 112.94.4, month open 112.94.5, and right back up. I have us at resistance now, and after the election. So if dollar's lower, there's literally zero room for this to to move up. Otherwise, we're going to end up with what I think is probably, we'll call it a fake out type of move. But remember, 13.95 is a level. You got an area up there. It's basically, it's a high from 10.8, just kind of when we accelerate to the downside. So I pay attention to that. I also, want to bring in the interest rate story on this. So if we look at TLT, right here, all right? So here's TLT. Remember our special report. We were thinking that 111.90 could be a low, and lo and behold, right now the low is 111.90 last week on Friday. Market hasn't done much here. Pulled up about half the week's range, and now we're fading into it. But looking for a low, looking for TLT to turn up, and let's remember what TLT is, right? It's a long-term bond, and if we look at the long-term yield, this is the 30-year yield. We're currently 322. The trend line is about 327, 328. So, one more push, and then that's all she wrote. That would be ideal. And then you get the dollar to turn over. So, if we do have a quick dollar reaction today, and we have a positive yield reaction today, then I would be, I wouldn't get trapped. Let's put it that way. We're in a market that seems like it is ripe with traps. Traps are set up all over the place. And a lot of it has to do with this yield story. A dollar yen move to the upside to me would be very trap-like. Okay, so I'm not going to be chasing dollar yen higher. It's just not for me with the setup and everything here, with the yield being so close to resistance, and again, bonds at support, which is the same thing. And this is, here's the yield, and let's put up dollar yen for you. So generally speaking, go to a daily. I mean, you can see that the yield story, dollar yen yield story, at times they haven't gone together, right? Remember late last year and early this year, it was kind of weird. Well, that story is back, right? This is back. So we know that the yield is, like I said, so damn, it sounds like a broken record, but it's so important. The yield is so close to major resistance. We're starting to see DSI get up or get down to, in the teens in yen. So that means it'd be basically in the 80s in dollar yen. And we've got dollar yen pressing up against longer term resistance as well. We've gone through the dollar, blah, 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 blah. If we're patient enough, there's a setup. We don't want to get, freak out and get FOMO and start chasing everything, for breakouts and this and that, when I don't think we're in that type of a market. So there's my story, and I'm sticking to it. Let's move. This is a good segue to go into indices. Want to look at the Nikkei. So the Nikkei hasn't retraced nearly as much of its decline as the U.S. indices have, and we will get into that. Wondering, this is a fork, okay, confirmed with the median line touch back here, which was obviously a big low, and looking for the angle off of this. That's good enough. We'll go to the 4-hour chart, okay? 4-hour chart, 200 average, a little higher. So if you do pull off some here, we haven't really stopped at a good place, like it seems very random. So with the Nikkei, I would think that you could probably sneak a little bit higher. Not going to spend too much time in this chart because it doesn't look very clear to me at this point. There are some that do. So let's go to one of those. I think this is the most important chart to follow for indices at the moment. It's the Shanghai Composite. Shanghai Composite, this is a shift fork from the January high. So we are looking at the angles that define the downtrend for this year. Stock market low. If we can get 2 equal legs, I think that's your top. And look at 2 equal legs is 27.47. You know where that is? That's right here where the 4-hour average is the 200 average is on the 4-hour chart. It's also the upper parallel. It's also this red line, which you're going to see where that comes from in just a moment. So I'm kind of like, to me, this is the big test for everything. Like we get one more push in markets, and then that's it, right? Now, you have to be prepared mentally to change your mind, because if we go up through here, then something else is happening, right? And the markets are more bullish than we previously thought. Okay, we were, not surprised to see a bounce. We got this bounce, then I put out the thing where you could have a crash. Didn't happen. Move on. We get up here, take your shot at resistance on the downside. But if we fail to turn down from here, then, you can't just sit there and be wrong. It's okay to be wrong. It's not right to stay wrong. So this is the big spot. So follow this chart, SHCOMP, the Shanghai Composite, right? This is what you want to be following. And again, why? Well, look at this. If I put up SPX, for the most part, the turns, right? And it's just the turn. That's the important part, because we have seen some periods of drastic divergence this year. But look at where the top was back here in September. It was just as China was putting in a top, a lower high. Okay, obviously the lows were together. Now we've come up together. So we get that top in China, follow the chart that's clean, then you're going to see it. Now, we could have support down here on the median line as well. All right, so this is why I'm following this chart so closely. All right, now I told you you'd see where these longer term levels come from that we're looking at. I'm going to go to a weekly chart now. Trend line from 1996, 2001, 2013, 14, right, 2005. That's where that red line is. Again, let's go back to that 4-hour chart. That's where that red line is. Pretty big, huh? This is just a channel, okay? We're going from the 2007 high and the 2015 high. The center line, obviously very important. Bounce from it here, bounce from it here. You get below here, and it's what I would call Crashville, right? With the next spot being this parallel here, which was equidistant to this one, call that the 12.5 or something. But then you've got your 25 line resistance here in Jan, your 75 line support back here in 2011, and then where we took off from in 2014. Okay. So great reference points to work with when it comes to the Shanghai Composite. All right, so well, that will take us then to, we'll go to the S&P, NASDAQ. I'll go through a couple different so-called versions. All right, we can take a look at the CFD, the futures, the ETF, what have you. All right, let's start with the S&P. We'll start with the CFD, I suppose. All right, so here's the CFD. This is SPX 500. When you look at the longer term, let me go to daily real fast. It's going to be a little messy when you look up here, but I want you to remember where this comes from. This is a shift fork from the 2009 low, and see the red line, right? How important that red line is as a reference point. So if we go, I want you to know where that red line is, because if we get back down there, to me, that's probably support, right? At least for a trade. Look, we've already retraced 618 of the drop, okay? The underside of this trend line, though, back off the April and May lows, which was resistance here in October, with the understanding of the Shanghai Composite potentially having another little run in it, right? Up to that trend line that we just looked at, the upper parallel. I'd respect the potential for us to have one more push, right? And look where that would put you. That would put you up around, the 2845 region. That's a level here from July. Support right here in August before you went higher again. Two equal legs is 2863. And the January high is 2877. So you've got this whole region up here where, we could sneak. Okay, at the same time, this long-term line here, you've got to be aware of this, the one in red. It's basically going to be 2740. Okay, just look across the chart and look at 2740. So wave-wise, this is 5 down. So we should be looking for a lower high, right? The question is, where does that lower high come in? Does that lower high come in? I think it comes in somewhere on this line. That's kind of all I want to get at. But we'll watch this in conjunction with the Shanghai Composite and see if we can find the point at which we do top in real time. So this is what I'm following, right? At home, I would just draw this line and I would set the alert. And when it goes off, I would buy puts. This is a good question from Ty. Ty is asking, what is the difference between a regular fork and a shift fork? Okay, that's a good question, Ty. So there are three types of, three main types of forks, okay? Why don't we just we'll use the Shanghai Composite here as the example. Let's do that. So okay, here's the Shanghai Composite. Here's a daily chart, all right? Ooh, what did just happen? I just got an alert on Brent. Hold on. I got an alert on Brent because we just hit that level. Weird. I've long some energy stocks at the moment, and this one, for some reason, is ripping, even though oil's tanking. Whatever. It was on the 200-day average, so we bought it. All right. Sorry, I'm all over the place. Ty, I want to get back to your question. So, okay, if we were to draw a regular fork, okay, a regular fork is this, right? You have 3 points, and your bisector, okay, comes, so if we call this point A, point B, point C, you're drawing a line between point B and C, and then you're going from point A and going right down the middle. This works for steeper moves. Obviously, this is not anything right here. It looks as stupid, okay? Now, a modified shift fork is just a trend line. It's a channel. So that would be the channel, and your modified shift fork, what it does is it makes a channel, but if this is point A, it moves the distance between where the bisector starts rather than here. It moves it halfway down in time, okay, between points B and C. So you can see here, if you move it, the best way to do it is to kind of show it like this. So you're moving it halfway down. You see what I'm saying? Halfway down in time on this axis. Now, a modified shift fork moves it even more. It moves it halfway in time and price. So if we do a modified shift fork, or sorry, a shift fork, not modified, it moves it even more. Now, the best way to explain this for practical purposes is that you're looking for the angle that a market's trading on, right? You drew this. This worked for a little bit, and then it stopped working. And you drew this, and you're like, oh, that's interesting. And then it works. So it's just kind of playing and seeing what works, okay? All right, back to our regular scheduled programming. All right, so he goes, as Michael explained these things in Foundation of Technical Analysis Daily Effects? I do not think so. I don't know, but I don't think so. All right, so getting back to this 4-hour chart. Right here, so hard to do anything. We're on the 618. We're so close to the high, but sometimes the best thing is nothing and to do nothing. And frankly, you can see where I have alerts set on my screen. I have alerts set at 2740 and then up at basically 2860. So I'll trade these two levels. Now we get up here, it's shorting, but it's also looking to buy puts, longer dated puts out, right? Probably out to January or something. And then you'd be trading against it, taking some off the table and buying some here. All right, so that's SPX 500. If we look at SPY, the ETF, it's a little different. The 4-hour chart's right here. The level up here that I'd be looking at is just the January high, which is 286.60. And I don't have anything on the longer term fork for support, but just follow SPX 500 for that, the CFD. All right. Now let's move on to NASDAQ. And I did say, I know that Habib was in earlier and he wanted to, so we looked at some daily, but I know you wanted to look at, Habib did a longer term chart on the weekly. And I just, I'll point you, Habib, to let's not forget these charts, the longer term charts. And Habib, go to the long-term charts here, Habib, and go to S&P 500, and you can see like the really long-term chart, which is from 1871, which is a quarterly chart, which is pretty crazy. Again, good for context. So we bounce where we should have. Dow's getting a little frothy up here, and if we go to another high, you're going to see drastic divergence, and in my opinion, that would be like the sell of a lifetime. But in the meantime, we're going to work with shorter term stuff. And the NASDAQ, here's NAS 100, the CFD. The big things to follow here, in my opinion, are just your channel from February. Really solid stuff. You've got 618, 7272. Two equal legs is actually, I think, up here near the median line, which would be, man, that would be crazy if we got up there. Two equal legs all the way at 74.21. That would be essentially on old support, 73.91. So this area, 73.91, 74.21, that is a hell of a spot. And if you pulled back some on this, I'd probably be looking at just the Jan high, May high, which is a 38.2 at 70.06. Okay. Don't forget, corrections can get really complex. So like, you've got A, B, C could be up here, but C could be, like a 1, 2, 3, 4, 5. It could take a lot longer than people think. As it is now, C is 61.8 of A. So it's like the S&P where we have, and this is why I say looking at the Shanghai Composite is so important, because with the S&P and the NASDAQ, we are at resistance now. Like we've hit big levels, right? But there are bigger levels that could be hit. I mean, it's just it's just that simple, right? We've had a big run. One could say this is enough. The correction can be done now. But as we know, corrections or, counter-trend rallies do kind of tend to test the patience of everybody, okay? And we've got to get everybody to buy in before the market can pull the rug out. So that's why I'm saying it's so important to follow the Shanghai is the big resistance looks like it's up here. So I'm totally, going to respect the potential for us to do this, get up there. And if the Shanghai gets up there, maybe by that point, maybe the NASDAQ's up here. I don't know. One trade at a time. We've hit resistance and we're coming off some, but I would not be surprised if we get up here at some point later in the month. All right. So there is that. Let's go to the NASDAQ Composite. NASDAQ Composite is the cleanest in the terms of the 5 waves down from the top. 1, 2, 3, 4, 5. A, B, C. A, B, C is going to be 2 equal legs, 77, 99, 58. And you guess what that is? To the tick, basically, it's the October 9th high right here. It's also the high over here, okay, from June. So again, there's another chart where, the composite to me looks like it still has a little bit of room, to push. That's maybe the clearer one, in terms of U.S. indices. QQQ. Kind of a mess here. Sorry about that. Get out of here. Like NAS 100, NAS 100, I would follow this trend line. That's support. You basically got support at 172 at this point, which is going to be this high over here, 172.50. And actually, if you look at it this way, we can go to like a 30-minute chart. Let's say that we've got A, B, and if we get one more push, A, B, and then it's a C, and then 1, 2, 3, pull back 4, higher 5, get you your C wave, okay? So here again, you can see where, you get a dip, like in the Shanghai, you get this dip, and then you're looking for one more push, and then that's all she wrote. So basically, in summary, a little up down. 2 equal legs here is going to be 179.53, which is the gap at 179.57 from October 9th. Just above there, you got the lows over here from early September at 180.44. So dip, rip, roll over hard. That's my story, and I'm sticking to it. Okay, Dow has recovered the most, gone way through at 618, just insane. 26,485 is the number for the Dow that I would be aware of, okay? That's going to be the weekly reversal resistance. So if I go to a weekly chart, it's the close of the high week, right? We've also got this parallel up there. This was resistance for like 2 years. So right up here, okay? Alrighty. I want to make sure that I cover one last thing for Habib. So Habib, this is the fork that we're looking at. This is shift fork. This is a good example. Ty was asking earlier about the difference between, regular forks and modified shift and shift fork. This is a shift fork. You can see it's not a trend line. It's actually the bisector, or whatever you want to call, the median line, the center line. If it was a regular fork, it'd be coming up like this. If it were a modified shift, it'd be coming up like this. Instead, it's coming up like this. So it's shift up. This is S&P cash, and I think this is probably one of the cleaner ways to look at it. 28.48 to 28.73 resistance throughout this month, right? Support 27, 40, 45. It's the same levels we obviously were looking at on SPX 500. So, from a longer term perspective, I'd be looking like this, down, top here, secondary top in this area 28, call it 28.48.73. Pullback, trading wise, you'd have to be getting out of some here, but giving your room to let it run all the way down to the 25.30s and test the low from February. And you realize that if we were to get up into 28.70s, two equal legs would be exactly 25.36, which is exactly the low from February. Woo, wouldn't that be fun? All right, gotta run, gotta go. I'm gonna go and get ready for have a little lunch and get ready for FOMC so that I can tweet out all the good stuff and possible trade setups for you guys and gals here in a little bit. But I know we're heavy on, kind of equity indices and stuff right now, but as we should be, because that's where the action is, and it's very important to understand what's going on. So in summary today, folks, we'll see what FOMC does to the dollar. I am looking for this turn higher in bonds, turn down in yields. Again, might have a little bit more push. Let's remember FX-wise that the Japanese yen is in what I kind of want to refer to as a trap-like market, right? Dollar yen, people getting really bulled up on it. We're seeing DSI get extreme. If there's a trap trade anywhere, it might be people buying dollar yen in the next couple of days. So I'd be very careful of chasing that to the upside. I will not be chasing it to the upside. I will be looking for exhaustion and a top in dollar yen. And it's kind of one and the same with equity markets. We've got some levels to work with, but really pay attention to those levels in the Shanghai Composite. All right, I'll put up a chart in the swing update tonight of the Shanghai Composite so that you have it on hand, because I do think that's the most important market to follow at the moment. It's just really clear where the levels are, where the important levels are. Okay. All right. So thank you all very much for your time as always, and have a great rest of your day and rest of your week and a nice weekend. And I will be back with you guys next week, and we'll get this archived as soon as possible. And take care. All right. Bye, guys.